Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Dominique. As usual, it's fantastic to have you on the podcast show.
Thanks, Bilal. Thank you for having me back.
Great. Well, I mean, I guess where we can start is really on this year so far. In your view, what have you been most surprised by in terms of the overall macro picture so far in 2024?
The stabilization of inflation. It's amazing. I mean, if you look at H2 last year, inflation was dropping like a stone, and it really stopped very abruptly. And I was really taken by surprise, but with the benefit of hindsight, always helps. It's actually quite consistent with the BIS two regime view of inflation. You know, when you are in a high inflation regime, people pay a lot of attention to signals like energy prices. And so those get transmitted quickly to the whole price structure. And if you look at energy prices, they fell until about Q3 last year, then they stabilized, and boom, 1 quarter later, core inflation stabilizes. So in hindsight, I wish I had more faith in my own framework for inflation. I would say one of the difficulties with this disinflation is that we have only one precedent, the 1980s, and it was a very, very different ball game then.
Yeah, actually, maybe we could explore that a bit further. I mean, what are the main differences between the disinflation period that we've seen recently versus the 1980s? What would you say is the big difference between the two?
The biggest difference, in my view, is that this burst of inflation came after 2 or 3 decades of very low inflation. So we didn't have the issue with high inflation expectations, which was really the key driver of the cost of disinflation in the 1980s. Basically, the Fed had to inflict enough pain on the economy to bring down inflation expectations. And because those had been allowed to build up over, since the mid-1960s, basically, the bringing them down and rebuilding the Fed credibility was super painful. So this time around, it's much easier. At the same time, because we are coming out of 2 or 3 decades of very low inflation and financialization, monetary policy is not transmitting as well. So we have balance sheets, household balance sheets that are very strong. We have, as Powell was just saying, we've had businesses, household terming out their debt. So that interest rate actually will take a while to feed through higher borrowing costs. A big issue we have is that, the US is a services-driven economy. So if you look at the balance sheet of businesses, on the asset side, you don't have a lot of physical assets. So on the liability side, there isn't a lot of debt. Businesses don't need a lot of credit to fund their expansion because they are services economy. And with the huge profits, the share of profits has been going up again for a couple of decades. They've bought financial assets. So if you actually look at the ratio of net interest payments relative to value added, since the Fed has been hiking, it's been coming down. So lots of issues with transmission of monetary tightening. Perhaps the most important channel is wealth effect. But again, the distribution of wealth in the US is so skewed that its impact on consumption is actually fairly limited. So I'd say compared with the 70s, the task looks less difficult, less daunting. but the instruments may not be as powerful because of the structural changes in the economy.
Okay, so I guess, I mean, the way to think about it is in the 70s, 80s, central banks underestimated how inflation expectations were behaving. So that ended up being the big thing they had to fight too late. This time, you could say they're underestimating how tight monetary policy is because they don't quite appreciate how the effects are much, much weaker because of the reasons you've outlined. And perhaps that kind of goes to this larger question of, why hasn't the US economy gone into recession, or why haven't equity markets blown up, even though we've had this huge increase in, I should add, nominal interest rates by the Fed. People have said it's the biggest increase since whatever time period. And I guess you kind of answered that question, but perhaps you could, elaborate further on, why haven't we had this big recession?
So two other big factors in my view. One is fiscal policy. We have a deficit which is 6% of GDP when unemployment is close to the post-World War II lows. And so I'm not a fiscal fundamentalist, but this is crazy. We can't do that. I mean, Powell keeps saying very politely, fiscal policy is on an unsustainable path, meaning, it's an issue, but in the longer term, I'm not sure, if, we'll talk about it, but if Trump wins, pushes forward more tax cut, we have a bigger deficit. At some point, the bond vigilantes are going to make a comeback. But so one big factor, fiscal policy is super loose. And the other factor, which in my view, is not being discussed enough. I don't think it's priced in. It's the enormous surge in immigration that we've had for the past few years. Unfortunately, it's a very polarizing topic, so it's not being discussed as much as it should. But, if you look at the CBO, so the CBO is this government-funded think tank, religiously bipartisan because they have to cost the laws that Congress passes. So they really have to make sure they are not aligned with either side. They've raised their projection for immigration to 3.3 million this year, last year and this year, against 0.7 million and 0.8 million projections they made in 2022. So this is huge. This is having an impact.
How can this immigration happen? Because, obviously, Trump introduced all these policies to stop, people crossing the border. And then we had the lockdowns. Presumably that stopped people, crossing over. And then Biden, I didn't quite, I assumed he just continued all of those policies. But, is this legal immigration? Is it illegal immigration? I mean, why? Where's this surge come from?
So, as always, I think the pandemic was a catalyst for some long-term trends. So the long-term trends are that in the Western Hemisphere, there is really a breakdown of law and order in a number of countries, a breakdown of opportunities. And so you've had a very steady growth in flows of illegal migrants. I actually prefer to use the word undocumented because illegal is a very inflammatory term, and we need to think about this issue in non-emotional terms. It's real. It is very real. So you've had these very long-term trends of loss of economic opportunities. Then you had the pandemic, where the government was allowed to send migrants back for health reasons. Then that statute expired, and you had this huge surge, which is basically a reflection of very long-term negative development trends in the Southern Hemisphere. So you have that issue, and then you have the legal framework for handling immigration, which is an absolute disaster. At the moment, immigration courts in the US have a backlog of cases of more than 3.3 million. Actually, there is a link in my notes on immigration to the think tanks that keeps the count. But courts are overwhelmed by immigration cases, and the thing is, the way it works is that if you are an undocumented migrant and you cross the border, you get apprehended by the border patrol. You are given a date to appear in court, typically a few years down the road, because the backlog for claiming asylum, which you can do, is about 1.3 million. It's also enormous. And so meanwhile, you can stay in the US, and people, being left in the US, of course, try to work. The same mechanism applies to people who cross the border at legitimate points, but are not eligible. They are given a date to appear in court, and we have this enormous backlog. So, that problems requires a number of things. I mean, more than just putting more barbed wires and more border patrol. You need to give enough resources for judges to go through the backlog of immigration cases. You need to change the law, because the way the flows are managed and the level of flows, I don't think is socially and politically sustainable. So you need to tighten the immigration criteria, and then you need to, have a dialogue with origin countries so that there are more opportunities for people there. If the US is a major shareholder, the main shareholders in all the main international multilateral development agencies. So there is quite a lot of resources there, and it's perhaps time for the US Treasury to ask where that money is going and why are people's prospects so dismal that they try to get to the US at very great risk.
Okay, that's very informative. And in terms of the impact on the economy, then presumably there's a supply side impact and there's a demand side impact of this immigration. How do you think about that?
So absolutely. So on the supply side, as Chair Powell explained, and as the data shows, increase in labor supply. So if you look at NFP increases, they are well above
the payrolls data, the labor market data, yeah.
Yeah, so the unemployment is going much faster than before the pandemic, but unemployment is rising very gently, but still rising. So the size of sustainable employment growth has increased, unsurprisingly. Also, if you look at wages relative to unemployment, you can see that in this recovery, real wage growth has been much lower than during, for instance, the recovery from the GFC, which is why people are so unhappy about inflation, basically. Real wages fell. They've barely recovered to their pre-pandemic level. So that's helped this inflation. On the other hand, you've had an increase in consumption, which is very clear. And in fact, what is interesting about this cohort of migrants, they don't seem to be sending remittances back home. If you look at the balance of payment data on remittances, there is no change, despite the surge in migrants that started in 2021. You don't see it, which suggests, by the way, that they are planning to stay in the US for the long run. So that's a strong boost to consumption. And at the same time, there seems to be some evidence, so far anecdotal, but these large inflows of immigrants are also putting pressure on the housing market, on affordable housing, or the low end of the housing market, which could explain why rents inflation has stabilized since about 2022, 2023.
Okay, so there is a disinflationary impact insofar as it's pushing real wages lower because you've got this influx of supply, but at least services inflation may not go down as much as you would have thought because there's increased demand on the housing side from this additional increase in population that could be keeping rental inflation high. And so it's not unambiguously good from a positive supply shock perspective. There is kind of a negative in the
Definitely.
sense that it's keeping inflation high perversely.
Definitely. I mean, the US has underinvested in residential real estate since the GFC. You see that in the data fairly clearly, and especially in the affordable segment of the market. And I think it's coming back to haunt us through this surge in demand that's accommodated through higher prices, basically.
And this immigration, it sounds like it's very elevated right now. I mean, is that like a temporary story, or will it just naturally come down in the next few years? Or is it also a function of elections as well? So if Trump was to come in, maybe there'll be a different outcome there. If you had to
So,
forecast this immigration sort of jump, I mean, how would you do that?
so I would think that Trump will have less of an impact than people expect because even though Trump is very anti-immigration, he doesn't operate in a vacuum. There are legal issues. And for sure, Trump can increase enforcement. For sure, the law could be tightened. Penalties on hiring illegal workers could certainly be raised. But there is still the law. And then there is, there will be international medias at the border. If, some states in the US have taken a more aggressive approach to containing migrant flows. So there will be the outcry in international media about perhaps the US not respecting humanitarian laws or principles. So that will also constrain the administration. And then the other constraint is that the supply of migrants reflects, very deep seated developmental issues that won't be solved by us tightening border enforcement. So it could slow. It's probably going to slow. Also, people will expect that with Trump as president, there will be less of a welcome. But the underlying issues will still be there. And I think the flows are not going to suddenly dry up to zero.
So that could remain a net positive for growth for the US in the foreseeable future. On the fiscal side, large amounts of the legislation were passed a few years ago now. So presumably the fiscal impulse or the benefits of that are starting to decline. Is that the right way to think about it, or is there something I'm missing here?
So, estimating the fiscal multiplier is always tricky because the devil is in the details. For sure, the deficit is not increasing. It's very large. It's not increasing. But what I think is a really turbocharging US growth at the moment is this amazing industrial policy we are having. I mean, we're talking about 100 billion worth of subsidies given to industry every year for another couple of years after 2024. And so if you look at corporate investment, it's the largest ever relative to GDP. And what's even more daunting is that most of this investment is in the build-up of facilities, of manufacturing facilities. If you look at equipment investment, it's not kept up, which means that once all those foundries, solar panel factories will have been built, the next stage will be to procure the equipment, which will also, keep demand going. So the deficit certainly is not rising, probably not going to rise if Biden wins. We will probably get even some limited consolidation, assuming that, the configuration of Congress allows it. For instance, the Trump tax cut expire next year. Biden wants to replace them with higher taxes on big business and wealthy Americans. The Republicans are saying no, no. So, what will happen? So there will be some compromise unless, the Democrats win both houses of Congress, which seems very likely. And the thing is, Bilal, if you look at budget compromises over the past, the past decade, it's not very encouraging. So one thing that Republicans and Democrats seem to be able to agree on is just spending more. So,
you touched on the elections there. I mean, what are the implications of a Biden victory versus a Trump victory?
So
the economy.
For the economy, so we won't get deregulation. If Biden wins, we will get somewhat less expansionary fiscal policy. We will get some increase.
Less expansionary fiscal under who?
Under Biden. I think, Yellen was talking about, putting the public finances on a sustainable.
Okay, and that's mainly through higher taxes.
Yeah.
Oh, yeah.
So he will raise tariffs, but probably less aggressively than Trump. And that's it. Really, he's going to keep going with his industrial policy, which, in my view, probably a few years down the road leads to an oversupply of a cheap solar panel and other things. But for now, it's just boosting demand, at least.
And Trump victory? So some deregulation, lower taxes, presumably, depending if he wins Congress as well.
Exactly. So worse for the environment, but better for business costs, which is always, the trade-off with his climate change policies. So he will pick a point on the trade-off where businesses do better. So we'll probably have a fairly positive business and reaction and stock market reaction. So that itself will add a little bit of more stimulus to the economy, probably less immigration. So the impact on growth, a little bit ambiguous, probably stronger growth under Trump than under Biden. But again, looking at the news, the coverage of Trump's program, I wonder if we are not exaggerating the differences between Trump and Biden, because Trump likes to make outlandish statements. After all, he's a celebrity reality TV star. That's how he made his fortune. And journalists love to take him literally because that's how they get clicks. But, there are constraints that both he and Biden are subjected to. So there may not be as much of a difference as we think.
So, I mean, everything you're telling me suggests that growth will be fairly strong over the course of this year. If I look at consensus forecasts, they started off this year at around 1.5% for the US. It's moved up to 2.5%. So there's been a raising of consensus forecasts. And then at the same time, we have seen a soft patch of data recently. So payrolls data was a bit softer and some other PMI data was a bit softer. I mean, do you think we're at the point where the market is kind of expecting robust US growth? So then the risk is that we get a disappointment in growth for the rest of this year?
Not really. It's not my base case scenario. I have been in the 2.5% camp since the beginning of the year. I mean, if I think of what kind of scenarios could bring down growth, if you look at previous recessions, they were either caused by a shock like the mortgage crisis or the dot-com bubble, or Fed tightening, or a combination of the two. It's hard to think. We know the Fed is on hold, and it's hard to think of a shock. I mean, in my view, the sort of the biggest underlying weakness of the US economy is its banking system. We have a very large number of regional banks, which I think are not viable. We are not seeing widespread bankruptcies because the Fed operating framework requires banks to be flooded with liquidity. Also, the Fed has made it clear that no depositor in the US is going to lose money no matter what happens. They also have all those liquidity facilities. They are prepared to stand up should anything happen. So we're not seeing this. But it's there. I think it reflects the fact that the GFC was resolved with basically 4 behemoths, and then the rest that have been at a funding disadvantage do not have the economies of scale and so on and so forth. So those weaknesses are there. So in my view, the most likely scenario shock that could hit the US economy would be pervasive bank weaknesses, but the likelihood of that happening is very, very, very small. Definitely not this year. If the Fed has to resume hiking, then it's a different story, but definitely not in my view, not for this year.
I mean, you talk about Fed being on hold. So what is your view for the Fed this year? The market is expecting at least 2 cuts this year. The Fed themselves, I think, is looking for 3 cuts this year. What's your view on the Fed?
So the 3 cuts was what they said in March. I think they are going, the next SCP, which is next month, is probably going to show probably only one cut. But so in terms of the Fed, they've, Chair Powell keeps telling us that in order to start cutting, he needs enough confidence or a resumption of disinflation. And based on my view that, and which is Virash's view on oil prices, that there is a sort of floor around $80 a barrel, so not much downside there, and that the US economy is starting to overheat. I see inflation stuck around core PCE, stuck around 3%, and so the Fed unable to cut.
Okay, so, and for the benefit of our audience, Varesh is an oil analyst at Macro Hive, which Dominique is referring to there. So your view essentially is no cuts by the Fed this year. You think the Fed will be forced to revise its own projections for this year from 3 cuts to 1 cut. There has been some chatter, when we speak to investors, we speak to some of the smartest investors around the world. There's been murmurings amongst them that they keep asking us, do you think there'll be a hike, this year? I mean, what would we need to see for the Fed to hike rates? Because it doesn't feel like they would. The bar seems very high for them to really raise rates. But if we had to paint a scenario of them hiking rates, maybe not even Q4 this year, maybe early next year, so we give us a longer period to allow more scenarios. But what environment would they need to hike rates?
So they would need to see inflation move to a higher range in a convincing manner. So not just one high data point, but a series of a high core PCE print with a convincing and internally consistent macro narrative on why inflation is going up. So the narratives I can think of, so definitely an oil price shock, given that we are still in the high inflation regime, where inflation is very exposed to relative price shocks. Another one could just be, Trump victory and businesses getting really exuberant, business investment going even higher, an even stronger recovery in residential investment. That's another narrative that could go with a higher core PC and the Fed being forced to move to a tightening outlook.
Okay. And in terms of the Fed's thinking itself, I mean, what's their model of the world? I get confused often, with the commentary coming out of the Fed. I look at the data, look at what they're saying. Then I also think about R star and their projections for R star. We've done a lot of work in this area where, we think R star, in nominal terms should be closer to maybe 3.5%, 4%, whereas they're still closer to 2.5%, the neutral rate of interest rate. So, I mean, what's their model of the world?
So there is their model and there is their communications. In terms of the model, I think the issue is that they had too much faith, perhaps. And let me just preface this by saying that I worked at the Fed, I worked at the IMF. Being a policymaker is tough. And there's no question in my mind that, we have a group of super smart, dedicated people who are trying to do their best. But that said, things have happened. I think they had perhaps too much faith in the expectations augmented Phillips curve. So they thought that a supply-driven inflationary shock would take care of itself, which was the Fed creed. Before the pandemic, there is a very famous paper by Janet Yellen from 2015, I believe, Inflation, Dynamics, and Monetary Policy, or just making that point that if you have a supply side shock, you can ignore it, it will take care of itself. So they allowed the inflation regime to move to the high regime. So having been the model, after the model got falsified, they basically gave up on model and now are what I would call hyper data-driven. They are looking at core PC print, just like you and me. And so if you can figure out the direction of core PC, you can figure out where the Fed is headed. In terms of R-star, we just had this morning Powell tell us that it's a long-term concept. It's not very relevant to policy, to current policy, to real-time policy making. And to be honest, I kind of like this healthy skepticism. I'm not a big believer in the concept of a long-term R-star. There is some very credible quantitative work done by the BIS showing that, interest rates tend to move up or down more based on central bank policies than on the so-called factors that drive this long-term R-star. So I would say no model. It's all about core PC prints. And if you can figure that one out.
I mean, at the same time, when you listen to Powell and other Fed speakers, they say that policy is tight, and so it's going to feed through to the economy. So when they say it's tight, that implies they've got some implicit model about,
yes,
about R-star or whatever, not even R-star, but they've got some model of, okay, this is higher than it should be, so this should be contractionary.
Well, but if you listen to the reason why they say policy is tight, they say, oh, the labor market is rebalancing, so policy is tight, which to me is not very much of a, it's not something that you can empirically test, right? I mean, R-star is, R-star is basically, the value of R-star is basically given to you by whether the economy is expanding or contracting, which makes it kind of difficult to test for, what is the long-term equilibrium value of R-star, if there is such a thing, which, by the way, is exactly the BIS criticism that all estimates of R-star are based on the assumptions that there is such a thing as R-star, that balances savings and investment. rather than empirical work that would test for the existence of something like R-star, which the BIS argues, in my view, very convincingly that it doesn't exist.
Yeah, yeah. I mean, one thing we haven't talked about is, a year or so ago, people kept talking about household savings that they'd built up, excess savings during COVID that will run out. That will lead to the end of the consumption binge in the US. Yet, 1 year on from that conversation, the economy is doing fine. What's happened to excess savings? What's household consumption doing?
So I never liked that concept of excess savings because it meant that you knew what was trend savings. But in reality, you just observe savings. You saw a huge increase in government handouts, which was partially saved, partially consumed. Very hard empirically and even logically to have a strong conviction on what was normal, what was excess savings. I think and in fact, if you use a pre-pandemic trend to estimate excess saving, they have been spent a long time ago. So I'm not sure this conversation gave a lot of insight on long-term growth trend. I think what happened is that we had this huge inflow of migrants, 3 million last year, probably 3 million this year, and they've added to consumption. In fact, I've looked at the consumption of durable in absolute level and adjusted for population growth. And once it's adjusted for population growth, it's much less impressive. So I think the story there was never really about excess saving. It was much more about all these immigrants buying God knows what, phones, laptop, any kind of durables.
Yeah. Okay, so from everything I'm hearing from you, I mean, the punchline essentially is growth is going to be solid over the course of this year. Inflation is going to be sticky. The Fed won't be able to cut rates, and they'll be forced to constantly revise their easings away. And the risks of recession are fairly low, unless we get some big external shock, some kind of oil spike or something like that. There is some risks in regional banks, but you think there's enough backstops to sort of keep them contained. So overall, a fairly kind of positive on the growth side picture, I would say, but a bit more negative on the inflation side in the sense that the Fed won't necessarily achieve their target.
Absolutely. But I would add this is not necessarily negative for instance, for equity markets, because what you have is this inflow of migrants that's keeping the share of profit in national income at historical high. And at the same time, I mean, let me be a bit sarcastic here. What's a big deal with inflation at 3%? I remember when I was in grad school, I asked that question from Charlie Bean, who became the chief economist of the Bank of England. And he didn't really have a good answer. Now I know the answer because I'm older and wiser. But it's basically about central bank credibility, right? Once you allow the inflation target or the de facto target to slip up, you lose a bit of credibility. But I think there are many people in the market who are going to look at the strength of growth, the strength of profit, and say, inflation is stable. Yes, it's a little higher than it was before the pandemic, but what's the big deal? So this could, despite, the Fed remaining far from its inflation target, the growth in the macro mix could be quite supportive of equity markets this year.
Okay, well, that's a good way to wrap up our markets part of our conversation. Now, as you know, I always like to ask some questions on culture as well. Have you been watching any good TV shows, books, films? I'm always on the lookout for new things to consume.
Bilal, the challenge is always to find something you haven't watched. So let me take a stab. The movie Civil War, it's not been released in the UK yet.
It has been, yeah.
Okay, so it's a bit heavy, but it certainly gave me pause and made me think that it's better to try to find a compromise with the other side than to descend in civil war.
Yeah.
For something a bit lighter and more entertaining, I've watched Lessons in Chemistry. Not sure if you saw
Oh
it.
yeah, that's the one with what's her name? Brie Larson in it.
And, it reminded me of Matilda, which I used to watch with great delight with my children. It's an adult version of a character, an apparently defenseless character who manages to get back at people who have wronged her through her wits. So that's actually quite, if people need a relief, from all these negative headlines, this is actually quite a nice show to watch.
Great. Okay, it's good selection there. I'll look out for those. Well, on that note, actually, I should ask you, what's the best way for people to follow you?
There is only one way to follow me, which is Macro Hive website. And as you remind all our auditors, we have a free newsletter. A lot of my staff is in there. And of course, for our pro clients, I love all the questions, all the pushback I get on a daily basis. So Macro Hive is my home.
Great. No, I appreciate that. Thanks, Dominique. So with that, thanks a lot. As usual, it's fantastic speaking to you, and good luck for watching the Fed and tracking the US economy.
Thanks, Bilal.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.